What's going on YouTube? In today's video I'm going to be doing it is now the time to invest video again on a new UK stock that I brought last week. Best of the best. So if you're new to the channel, could you please subscribe and smash that like button. As always, there will be a link to a free share in the description of this video. Just sign up with Freetrade, deposit £1, you can get a share worth up to £200. Yeah, in today's video I'm just going to be going through best of the best, and if it now is the good time to invest, I want to briefly outline the company. I'm going to go through my investing checklist of what criteria I look for before I invest in the stock, and what the company's about, and then obviously I'll just do a quick valuation of the stock at the end, like pricing, see if it's valued at a decent price below its intrinsic value. So yeah, let's just get cracking into this video straight away. So best of the best. This company, it's a UK based company. It's listed on the AIM market, which is like for smaller companies in the UK. So it's not listed on the London Stock Exchange, it's listed on the AIM market. And you know, the AIM market's got a lot, in my opinion, it's got a lot of rubbish in there, but there's a few hidden gems in there, like Boohoo, Freetrade, stocks like that. You do find the odd hidden gem in the AIM market. So if it's a stock pickers market really. It's got a lot of small cap, even though Boohoo's, well, it started as a small cap, is rather large now. And this is obviously another stock that I've got, is Catebox. And yeah, this is listed on the AIM market. And I've seen best of the best before. Obviously it comes up on my Facebook page, it comes up online a lot, you know, it's buy tickets. It's like it runs a competition online it doesn't just do it online, but mainly online now, selling raffle tickets for a chance to win a luxury car and cash prizes. Predominantly online sales. Best of the best competitions include midweek car, dream car and lifestyle competitions. It's advertising similar to postcode lotteries. You know, you get the videos where somebody's won, they knock on the door, say you've won a new car and £50,000 worth of cash. So it's very similar to that. So I've seen it around a lot before, the actual business online, and I've nearly played it before, to be honest, and you know, I'm still tempted to play it again now. Like, so the posts online are very engaging and they do draw you in. But I didn't realise it was listed as a public company until I seen it on another YouTube channel, JKR Investing, which is a great YouTube channel in the UK. So yeah, please check that channel out if you're interested in the stock market, because he just breaks down his stocks and he's very transparent about what sort of stocks he buys. Yeah, so that's how I've really found out that this was listed on the public markets. So yeah, that's basically the outline of the company. And then I'm just going to be going through, this is my investing criteria for the company. These are the 5 big numbers that I use to like break down to see if a company's quality and whether it might have a competitive advantage, a durable competitive advantage. And as a lot of people call it, a moat. These are my big 5 numbers, and I use them to obviously identify if it's the quality of the company. I've got these growth rates, I've worked these growth rates out over the last 5 years as an average, and I've used data from Simply Wall Street and Yahoo Finance. So first of all, the first big number is return on invested capital. Now this shows how good the management are in reinvesting the profits and the capital that the company has, and it's, like, you know, last year's, I think it's an average of 100%, but last year's one, I've just used last year's one for this example, is 156.9%, which is massive, and the average isn't that far off, that different. There's not much difference in the average either. So the company's obviously investing its capital well for its shareholders, and that's a big one first. So obviously if that one's no good, it's not really, like, you know, worth maybe building a big position in the company, in my opinion. So that's a big one on my criteria and my checklist. So I do like that one to be a decent size. Anything above 10% on any of these growth rates is good. So that's like 15 times more, and on average it's 10 times more than the 10%. So that's an amazing return on invested capital. The second growth rate is a sales growth rate. Now this is important in a lot of growth stocks. You want it to be 10 to 20% for any growth stock really that's looking to build a business and grow its revenues and its profits at a reasonable pace, and it's 36.8%, which is an growth rate as well for its sales and revenue. EPS growth rate, so its earnings per share and its earnings have gone up 75% over the last 5 years, on average a year, which is an amazing growth rate. And it's obviously the sales and revenue has only gone up 36%, but the earnings have gone up twofold, because one, the sales and revenue have gone up, and two, the gross profit, the profit margins, the gross profit has gone from something like 6% to 25%, 26%. So that's an amazing achievement as well, and I think that's a lot of it's going to online, and they've been able to use their it's less capital intensive, isn't it, doing it online than physical. Because you used to see these in the airports a lot, apparently. So you'd come out of an airport and you'd be able to buy a ticket and win a chance to win a car. But now it's a lot of social media, and obviously it exploded during the Rona last year. So yes, that's why the earnings have gone up, twofold, which is a massively great sign for the company. It shows that it's for every pound that it uses to make the cost of revenue, it's making 60p, and so it's making 25p rather than 6p it was before for every pound. So that's an amazing return there, and that's another good sign that the management's doing well. And then the equity growth rate, how much cash and what the company's got, has grown at 20% a year for the last 5 years, which is another great growth rate there, above 10%. And then obviously the last one is cash growth rate, which has grown at 52% over the last 5 years. So it's retaining its earnings in cash, and its cash positions increased significantly over the last 5 years. So yeah, as you can see, it's smashed every single one of them growth numbers, the more big 5 numbers for my investing checklist. So yeah, that's why it's not just on my radar, it's smashed every number on my growth checklist. And then the last thing I look at is debt. It's not a big 5 number, it's not a deal killer, because some companies can have debt, I don't mind that. But ideally, I'd like them to have no debt, or to have be able to pay their debt down with 3 years free cash flow. So how much free cash flow is in the business? They can pay their debt off in 3 years. That's great. But what I find is with the companies that once I've done my checklist, strong companies, that are performing over 10%, normally pay their debt down within between 6 months to a year. And the companies absolutely smash all 5 of the big numbers on my checklist, normally have no debt at all. So your likes of Boohoo, Facebook, they've got similar sort of, not similar numbers, but they've smashed every single growth rate number, and they have no debt. So that's just another side of the quality company, and it does give me an indication of whether these numbers that I'm measuring my companies by work. And I think they pretty much do, because what I've seen is that every company that's smashed their big 5 numbers and done over the 5% over a long period of time doesn't have debt, or has a very minimal debt. And obviously here's a quick graph of all the earnings per share, revenue increases, cash flow increases, cash position, equity increases over the last 5 years, and I got this data from Simply Wall Street. So yeah, it's an app I use, and an app a lot of people use to help with their analysis. It's a good tool. It's a good tool. You can either use a paid prescription where you can look at unlimited amount of stocks, or you can just have the free package where you can just do 6 stocks a month. So yeah, let's move on now from big 5 numbers, and we'll go on to valuation. So as you can see, I've got my growth rate, and which I'm using the equity, because obviously to know whether you're going to get a good return on your money is if the equity in the company is increasing. So the company's getting bigger, and the equity in the company is increasing over a period of time. That's where you'll get your returns from in the share price over a long period of time. And obviously, I've used a 20% equity growth rate over the last 5 years. The PE ratio at the moment is quite low. It's 13. So that's another good sign. It's not massively stupid valuated 40 times PE. Or something like that for a small company. So it's got, that's an indication it's relatively cheap. I know it's also got a PEG ratio, price to earnings and growth ratio of around about 1, which is always a good number for a PEG ratio. It shows it's got a good price to its potential growth. But obviously I don't need that for this calculation. Obviously it's earnings per share there. So just something 21 pence, 22 pence a share. earnings per share, and then my minimum rate of return is 15%. So what I do then is I times the earnings per share, the current earnings per share, by 20%, and I do that 5 times to get the 5-year EPS, the 5-year, my estimated 5-year earnings per share. And then what I do is I times that by 25, but I think that realistically in 5 years' time this company could have a PE of 25. And that gives me a price, a 5-year share price of £75.75. But because I want a rate of return of 15%, so roughly doubling my money every 5 years, I have to divide that by 2. So 75.75 divided by 2 is £37.87 per share. That's what I've got as the current value of the company. If you know a fair value to buy the company today to get that 15% return. But obviously, that's if everything goes perfect and the company's projections and the company carries on doing well, and that's what I'll get. That's why the big 5 numbers are so important, because that gives you an indication of whether the company's going to do well going forward, and obviously the big 5 numbers give that indication as best I can. I haven't got a crystal ball, but it's the best indication I've got to know whether the company's going to do well over the long term. So that's why I do them big 5 numbers. So if a fair value 37.87. Now, obviously, I've got the sources from Simply Wall Street, and they've got the company at fair value of £36.58, which is not very far off from what I've got it with my calculation. So that's just another indication that I use this tool to gather whether I'm working the company's valuations at a decent price and whether mine match up with Simply Wall Street and how far out they are. And yeah, so that pretty much tells me that it's roughly around the £35 to £40 mark that this company is a fair value at. And obviously the current price, as you can see, is around about the £16.20 mark, which is over half of that at the moment. But obviously I've just spoke about this is if everything goes perfectly fair priced, I'll get a 15% return over 5 years. But things can go wrong. Obviously, we've seen last year, it affected the events of last year affected some businesses worse than others. So if this had an event, say this company had an event that was as debilitating as, say, whatever happened last year, the events that happened last year that affected like the travel and leisure industries, then this company would suffer financially. So what we need to do for that then is we need to have a margin of safety. So, get it at such a cheap price that even though you could have some headwinds down the next 5 years or so, you're still going to be making a decent return. So I'm looking to double my money every 5 years. So then what you have to do is you have to buy at a margin safety price. So I just divide the current fair value by 2, and that gives me £18.93 a share. And that's my margin of safety price. So now if everything does go right, then I'm not just making 100% on my stock, I'm making 200% on my stock, which is like, an amazing return over 5 years. So that's the way I see it with this one. And it's currently at £16.20 a share, or £16.22 when I made this slide for this video. And thereabouts, there is a bit of a spread on the account that I've brought this in, because I've brought this in Hargraves Lansdowne account. So obviously I have to be careful when I'm buying. I have to buy in big bulks, and then I have to let it go. If I want to buy more, if the price goes down, I have to let it go down a little bit more to buy more. So I've made an initial position into this company, and I'll be looking to buy more over the coming 12 months to building my position in this company. I think it's a great company. I can't currently get it on Freetrade, which is a shame, because I'd like to be building this up in my Freetrade account as well. So I think it's a high quality growth stock. It does pay a dividend as well. It's just paid a 50p special dividend to its shareholders. So that's just an added bonus there. It's a quality stock, and I'm looking to hold this one for at least 5 to 10 years now, unless the story changes. But everything about this stock has told me it's a quality company and it's priced at a great price, in my opinion. Remember, I'm not a financial advisor, so please do your own research. I've just shown you what research I've done to get to the point of where I'm ready to invest into a company. So in my opinion, my personal opinion, I think now is the time to invest in this company, and I will be investing in this company. So I hope you've enjoyed this video. Please smash the like button and subscribe to the channel if you're new to the channel. Hit that notification bell if you want to get future videos. I'll do portfolio updates and stock analysis videos. So yeah, I hope you've enjoyed this video, a slightly different format, and I'll be doing a portfolio update soon. Remember to sign up to your free share in the description of this video. Have a nice day, guys.